Most people think mutual funds are either too risky or too boring. But what if I told you the truth is far more surprising and it could decide whether you build wealth or totally miss it out? Here's a question for you. If mutual funds are so simple and popular worldwide, why do so many investors still fail to make the best use of them? Is it because of the markets or is it because of what they don't know? Hi, welcome to this video. In this video, let us see 10 truths about mutual funds that everybody should know. You may know some of them or it could be new. If you think you agree with these points, do let me know in the comment. Let's begin. Here's the first truth, and it's one most people completely misunderstand. A mutual fund is not an asset class, it's a basket. Think about it this way: when people say I invest in mutual funds, they often treat it as if it's a separate type of investment, like stocks, bonds, gold, or real estate. But the reality is, a mutual fund is simply a container. Inside that container, you can have different asset classes like equities, debts, gold, or even international funds. So, when you say you have invested in a mutual fund, what you are really saying is you have invested in a basket that holds these underlying assets. The fund is just the vehicle. The destination is decided by what's inside it. Imagine you walk into a supermarket. You pick up a shopping basket. Now, the basket itself is not food. What matters is whether you fill it with fruits, vegetables, or junk food. A mutual fund works exactly the same way. The label on the basket might say equity funds, debt funds, or hybrid funds. That label tells you what's inside. But never confuse the basket to be the product. Also, you have full control on what your basket is filled with. Make sure you know what you want, otherwise, copying others' basket could be risky for you. This truth is important because it changes how you think about investing. If you thought about mutual funds as one big category of investment, you might believe all funds work the same. But once you know them as a basket, you realize different baskets serve different purposes. An equity basket could help you grow wealth over time. A debt basket could give you stability and lower volatility as compared to equity. A gold basket might protect you during inflation or uncertainties. That's why it's known to be a hedge. And suddenly, mutual funds don't look like products, they look like a flexible tool where the outcome depends on what you choose to put inside. So remember, a mutual fund is not an investment category, it's not the destination. It's a basket or a tool you can use, and the real story is always what you choose to include inside it. Here is another truth that confuses a lot of people. The NAV, net asset value, of a mutual fund is not the same as the price of a stock. They look similar, but they work differently. When you buy shares of a company, the price tells you how much one share costs. If the share price doubles, your wealth doubles. So naturally, many investors think the same way about NAV. They believe a low NAV means a fund is cheap and a high NAV means that the fund is expensive. But here's the truth: net asset value is simply the current value of all the assets inside the basket divided by the number of units. That's it. It's just a calculation of value, not a signal of growth potential. Think of NAV like the split bill after a group dinner. Suppose 10 friends go out, spend 10,000 rupees, and split the cost equally. Each person pays 1000 rupees. Now imagine next time 20 friends go out and the group spends 20,000 rupees. Each person still pays 1000 rupees. The cost per head stayed the same, even though the total expenses doubled. That's what NAV is like. It tells you the per unit value of everything inside the fund, not whether the fund is cheap or costly. So, whether a fund has an NAV of 10 or 200, it doesn't tell you anything about the future returns. Both can grow at the same rate because the driver is the performance of the underlying assets, not the starting NAV. In other words, it's not the NAV that creates wealth, it's what the fund holds and how those investments perform over time. Knowing this matters because too many new investors chase low NAV funds thinking they are getting a bargain. But focusing on NAV is like judging a book by just the size of its cover. What matters is the content inside. When we talk about mutual funds, it's the content, which is the stocks or bonds or other assets that the fund actually holds. So the next time someone says, this fund is cheap, look at the NAV. You will know better. NAV shows you value today, but it doesn't predict value tomorrow. If you agree with this, tell me in the comment. Type agree in the comment. Here is a truth that surprises a lot of first time investors. SIP is not a product, it's just a method or a system. Many people say, I invested in an SIP, but technically that's not correct. An SIP or systematic investment plan is simply a way of putting money into mutual funds at regular intervals, say, for example, monthly or quarterly. The fund you are investing in, whether it's equity, debt, or hybrid, that's the product. SIP is just the mechanism you use to enter into the investment consistently. Think of SIP like a habit. Imagine going to the gym. The gym is the product, the place where your fitness journey happens. But going every morning at 7 a.m., that's your method, that's your system. Similarly, in investing, SIP is simply a disciplined routine of adding money bit by bit into a fund you have chosen. Remember, you should know how to choose a fund in that case. One should know this because many people assume SIP itself guarantees high return. They treat it like a magical scheme that will automatically improve their investments. But that's not true. The returns depends on whether you have invested in the right fund and where your SIP is going. If your SIP is in equity funds, it will move based on equity markets. If it is in debt funds, it will move based on debt markets. SIP doesn't change the destination. It just helps you walk the path more steadily. So why is SIP so powerful then? Because it builds consistency. It reduces the pressure of timing the market and it makes investing a habit, something you do automatically without second guessing. In a long run, this habit can make a huge difference, not just in investments but in any area of life. If this makes sense, don't forget to hit like and subscribe. It encourages us to keep creating content that simplifies investing for you. So remember, SIP is not the investment, it is the method. And when you combine with the right fund, it becomes one of the most effective ways to build wealth step by step. Here is an important point that every investor must remember. Past returns don't guarantee future results. Mutual funds are often judged by their track records. You will see documents and websites showing 1 year, 3 year, or 5 year, or more than that performance numbers. And naturally, many people assume if a fund grew by 15% in the past, it will keep doing the same thing in future. But markets don't work that way. Returns are not like a fixed deposit with assured interest. They are reflections of how the underlying assets performed during a period of time. And since markets keep changing, future results can be very different. Think about a cricket player. If someone scored a century last week, does that guarantee another century in the next week? Not really, right? The conditions may change, the pitch may be different, or the opposition may be stronger. Similarly, a fund that performed well in the past might face different conditions tomorrow. That's why relying only on past performance or returns is like driving forward while looking only in the rearview mirror. This doesn't mean past performance is useless. It can give you a sense of consistency or how the fund handled ups and downs. But it should never be the only reason to invest. Instead, focus on the process. Check if the fund sticks to its stated strategy. Is it managed with discipline? Does it align with your goals and risk tolerance? Those are the real questions that matter. By knowing this truth, you protect yourself from a very common trap. Many investors chase the best performing fund of last year, only to be disappointed when it doesn't repeat the same performance next year. Understanding that past returns don't equal future results helps you stay realistic and make smarter choices. So, the next time you read reports or numbers, remember this: history shows you where it has been, but your future depends on where it's going and how well it fits into your financial plan. Here is a truth that can completely change how you look at investing. Risk is not high or low, risk is personal. You might ask, how is risk personal, right? Mutual funds often come with labels like low risk, moderate risk, or high risk. While these labels are useful, they only tell you part of the story. What really matters is not how risky the fund is in general, but how risky it feels for you based on your goals, time horizons, and mindset. Because the same fund can feel very safe to one person and extremely risky to another. Imagine two friends, both investing in the same equity fund. One is 25 years old, starting her career with 30 years ahead to build wealth. For her, short term ups and downs don't matter. She has time to recover. The other person is 60 years old, planning to use the money for retirement in the next 3 years. For him, even small fluctuations feels dangerous because the timing matters. The fund is the same, but the risk feels completely different because risk is personal. This is why no fund is universally safe or unsafe. Risk is always linked to context. Equity funds are often called high risk, but if you have patience and time on your side, they may actually be the most rewarding investments. Debt funds are called low risk, but if you expect very high return from them, you will feel disappointed and think of it as a risky investment. So, risk is not an absolute number, it's an emotional experience shaped by your situation. Understanding this helps you stop comparing your investments blindly with others. You realize what works for your neighbor, colleague, relatives, or friends may not work for you. And that's perfectly alright. Because in investing, the real measure of success is whether your money supports your goals, not whether you chased the same thing as everyone else. So the next time you hear someone say, this fund is risky, pause a bit and ask, risky for whom, or gather the context of that statement. Because at the end of the day, risk isn't just about numbers or figures or charts. It's about how you experience the journey personally. Here is another truth that will save you years of confusion. Diversification doesn't mean collecting variety of funds, it means spreading risk wisely. Many investors think that more funds they have or more funds they hold, the safer they are. But owning 15 to 20 funds is like buying the same item from different shops. You don't actually get variety, you just multiply clutter. Imagine you walk into a wedding buffet. You take rice from 5 different counters, thinking you are diversifying your plate. I know it's a silly example, but let's continue. In reality, you are still only eating rice, just in larger quantity. Real diversification would mean you mix rice with dal, sabzi, roti, and salad. That way, if one dish is too spicy or bland, the other one balances it out. The same way, In a portfolio, if all your funds are equity large cap funds, you're not diversified. You are just repeating the same flavor. True diversification is about spreading across asset classes like equity, debt, gold, and maybe international funds or a mix you would prefer so that when one underperforms, another supports your goals. Owning 3 to 4 thoughtfully chosen funds is often more powerful than owning 15 random ones. Because what matters is not how many funds you own, but how different they are from each other. When you understand this, your portfolio becomes cleaner and easier to track and more aligned with your actual goals. You don't have to worry about where the SIP has to go among 15-20 funds. You spend less time worrying about overlapping funds and more time watching your money grow with clarity. If you have ever felt like your investments are scattered, this truth should bring you more relief. If this is giving you a fresh perspective, don't forget to like and subscribe. So remember, diversification is not about quantity, it's about balance. And once you see it this way, your investments and your peace of mind both get stronger. Here is another truth where most people either ignore or overestimate. Let me bring it on. Fund managers are not fortune tellers. Yes, fund managers are highly skilled. They have access to research teams, advanced data, and decades of market experience. But no matter how brilliant they are, they cannot control markets. They can only manage within the rules of discipline. Let's go back to our cricket example again, shall we? Let's say the world class captain can pick the best players, plan the fielding positions, and set a strategy. Everything is well planned. But can he control weather if it rains? Or can he control the pitch suddenly if it cracks? No, right? The captain can only manage the game with skill and adapt. But the outcome also depends on external conditions beyond his control. That's exactly how fund managers operate. Many investors think if I choose the top rated fund manager, it will always get the best return. But that's like saying if I choose the best doctor, I'll never fall sick. Skills matter. Yes, that's true. But so does the environment. Even the best fund managers go through underperformance cycles because markets move in phases or cycles. Sometimes favoring growth, sometimes the value, or sometimes the debt. No one can predict perfectly what will happen next, or not even the smartest will be able to tell what's the right thing to do. So instead of chasing star fund managers, focus on choosing funds that follow a consistent process, have a clear investment mandate, and fits your goal and time horizon. Because in the long run, process outperforms personality. When you stop expecting unrealistic performance, you stop getting disappointed by temporary underperformance and you start focusing on what really matters. That is, staying invested, diversified, and disciplined. If this truth gave you a new perspective, make sure to share it with a friend who believes there's a secret in investment which no one knows. Remember, fund managers are skilled professionals, but they are not fortune tellers. And that's actually a good news because it means your success depends more on your discipline than on anybody else. One of the biggest myths holding people back is this: mutual funds are only for experts. Truth is, they were designed for everyone. When mutual funds were first created, the idea was not to give Wall Street or Dalal Street professionals another ground. It was to give ordinary savers a simple way to access markets without needing to pick individual stocks or securities. In fact, the whole point of mutual funds is to make investing accessible, simple, and convenient. Think about ordering food online. Do you need to know how to cook a 5 course meal before you order? No. You just need to know what you want, and the delivery platform takes care of the rest. That's exactly what a mutual fund does with your money. It pools the money, manages it, and delivers you a diversified choice of portfolio. Many people avoid funds because they feel I don't understand the economics or the working of mutual funds or I'll make a mistake. But the truth is, avoiding investing because of fear is a much bigger mistake than starting small and learning along the way. Some of the most successful mutual fund investors I have met are not finance grads or mathematical experts. There are teachers, engineers, homemakers, students, freelancers, and many people who simply understood that you don't need to be an expert to invest in funds. You just need to start, stay disciplined, and let compounding work for you. So here's the mindset shift. You don't need to master stock charts or balance sheets to benefit from mutual funds. You need to most importantly know what you want, what are your goals, and how much can you invest in small SIPs. And then master your habits. Invest regularly, stay patient, review occasionally. The system is already built to handle the rest for you. Once again, let me highlight mutual funds are not only for experts, they are for ordinary people who want to grow their wealth without becoming full time professionals in finance. And that's why they are one of the most powerful tools available to anyone, anywhere. One of the most important lessons every investor must learn is this: short term ups and downs are normal, patience is the real key. When you invest in mutual funds, especially equity funds, the markets are bound to fluctuate. Some days it would be rising, some days it falls. That doesn't mean you're losing money. Over the long term, these short term swings often smooths out, and the power of compounding rewards those who stay invested. What happens when you plant a seed? You water it, take care of it, and wait. Some days it rains, some days it's dry, but you don't dig into it every time it looks droopy. Eventually, it grows tall and bears fruits. Investing works exactly the same way. Short term pain is part of long term growth. Many investors panic when the market falls and think, I am losing money and I should exit. Quick decision, right? But the real mistake is reacting emotionally to normal volatility. You should stay calm, stay invested, and give your money time. This is what separates successful investors from the rest. Think of the stock market crash of 2008. Those who panicked and sold lost years of growth. Those who stayed invested and continued SIPs not only recovered but saw their portfolio multiply over the next decade. Patience truly pays. So here's the mindset shift. Don't treat every dip as a disaster. Focus on your long term goals, invest consistently, and let compounding work its magic. Volatility is not the enemy, impatient definitely is. The point to remember is short term pain is part of long term gain. If you can stay disciplined and patient, the market rewards you over time. And that's how wealth is truly built. One of the most powerful lessons in investing is this: people chase quick returns. The truth is, successful investing is never a sprint, it's a journey. Markets don't move in straight lines. Some months your portfolio may soar, the other months it may dip. The key isn't speed or timing the market perfectly, it's consistency, discipline, and focusing on your long term goals. That's why it's important to start with personal goals. Wealth builds gradually, like river carving a valley over years. When you learn a new language, you won't become fluent in a week. You practice a little every day, make mistakes, and slowly improve. Eventually, fluency comes naturally. Investing works the same way. Small, steady steps lead to good results over time. Many people quit or panic because they feel progress is slow. They think, why isn't my portfolio growing as fast as someone else? But the truth is, chasing speed often leads to mistakes and losses. Staying invested, learning over time, and being patient is far more effective than rushing. Another key part of the journey is regular review. Checking your portfolio occasionally helps you ensure it stays aligned with your goals and risk tolerance. It's not about reacting to every market dip, but making small adjustments when needed, like pruning a tree to help it grow stronger. Look at long term investors who stayed with equity funds for over 10 to 15 years. Some of them have stayed there for more than 25 years. They didn't get rich overnight, but through steady investments or SIPs, patience, and occasional portfolio review, their investments multiplied many folds. They treated investing like a journey, not a race, and that mindset made all the difference. So here's the mindset shift. Stop worrying about daily market moves. Instead, invest regularly, review occasionally, and trust the process. Compounding works best when you give it time, and a healthy portfolio needs both patience and periodic checks. Investing is a journey, not a race, and the sooner you embrace this mindset and review your portfolio regularly, the stronger your financial future will become. Hope you enjoyed our discussion so far. Thank you so much for being here till the end. We are looking forward to hear from you. Share your thoughts in the comment if you found this helpful. Hit like, share or subscribe and share it with your friends and family. Stay tuned and be with us for more simple, practical investing knowledge that can change your financial future. Let's grow together.